welcome to my new place. I just bought my first home, and although it was a little scary at times, the credit union helped me every step of the way. So, whether you're buying your first home or haven't bought a home for a long time and need a refresher, I think you'll find this information very helpful. Come on in. You know, I never really thought about the possibility of owning my own home until a friend of mine bought a house. I guess I just assumed I couldn't afford a home, much less qualify for a loan, but I was wrong. And now, my monthly payment is only a few $100s more than what I paid in rent. Now, it did take me a little while to get to this point, but I'll share with you everything I learned. And although your experience may be a little bit different than mine, I can at least give you an idea of what to expect. There are a few things you need to consider before starting your home search. First, you need to have a credit score of at least 640 to qualify for a loan. If you're not sure what your credit score is, or you've never worked on building your credit, you'll want to talk with a credit union lender. Your lender can tell you what your current score is and offer you advice for building or raising your score if needed. Second, you'll want to start saving. Depending on your budget and the price range of your new home, you may want to save for several months or even years before you buy. You see, there are a lot of upfront expenses to think about in addition to your monthly payment. These expenses can be broken into two categories: the down payment and the closing costs. You will be required to make a down payment on your home, which is simply a percentage of the sale price of the home. This percentage varies depending on the type of loan you get, but it generally ranges from 3.5% to 20%. In addition to your down payment, you need to save for the closing costs and other fees associated with a loan on your new home. These can vary greatly by lenders. Anytime you apply for a loan, a lender is required to provide you with a good faith estimate, or GFE, within 3 business days. This GFE document will break down all the closing costs associated with your loan, so pay close attention to it. Closing costs include the following: origination fees, underwriting and processing fees, title fees, appraisals, and discount points. While it's not necessary to memorize the purpose of each of these fees, you will want to refer back to this information when you receive your GFE. Origination fee. This is an upfront fee charged by the lender for processing a new loan application. Origination fees are generally between 0.5% and 1% of the total loan amount. This is what you pay the lender for completing all the paperwork and doing all the legwork associated with your mortgage loan. Underwriting and processing fees. These are fees paid upfront to the lender for reviewing your loan application and calculating whether or not the risk of offering a mortgage loan to you is acceptable. This figure may also include document fees, wire fees, and other administration types of fees involved in providing your loan. Origination and underwriting fees are the largest numbers you'll see on the good faith estimate, so ask ahead of time what lenders charge. It could save you hundreds of dollars. Title fees. These are fees paid to a title company to verify information about the home you're buying, such as who owns the property, its boundaries, and any liens or negative information that may be attached to a home or piece of land. You want to verify that the title of your new home is clean, even if it's brand new, to ensure you're protected from any financial or legal issues the prior owner may have experienced. Appraisal fees. Anytime you buy or sell real estate, you will need a real estate appraisal. The primary purpose is to find out exactly how much the property is worth. Discount points are one fee you're not required to pay. They're simply a form of prepaid interest designed to lower your interest rate and thereby lower your monthly payment. 1 point equals 1% of the loan amount, and each point typically reduces your rate by 1/8%. When you consider buying points to reduce your loan rate, you'll want to calculate how long you'll have to live in the house before you break even. For example, if you buy a $100,000 home at 5% and buy one point for $1,000, it will lower your rate to 4.875%. However, you will need to live in the home for nearly 3 years in order to break even. So in this scenario, if you plan to live in your home longer than 3 years, you'll recoup your money and enjoy the lower rate for as long as you live in the home. And it's good to mention that discount points are tax deductible. Now, you may be able to roll some of these fees into your loan. However, keep in mind that will increase your loan amount, thereby increasing your monthly payment. Phew, I know that's a lot of information, but stick with me because it's time to review the variety of loan options that may be available to you, and this is really important. Conventional. This is simply a loan that is not made or insured by a government entity. A conventional loan typically ranges from 10 to 30 years and offers a fixed rate for the life of the loan. A conventional loan typically requires a 5% to 20% down payment. So that means if you are buying a $100,000 home, you may need as much as $20,000 for your down payment. ARM, or adjustable rate mortgage, is one in which the rate adjusts on a specified schedule after an initial fixed period, but offers you a lower interest rate for the first few years. For instance, a 5-1 ARM means your interest rate is fixed for the first 5 years and then may increase up to 1% each year thereafter. This type of loan is considered riskier than a fixed-rate mortgage because your payment may change significantly after the initial fixed period. When is an ARM a good idea? When you have no long-term plan of living in the home and are pretty certain you will sell the home before the interest rate begins to increase. FHA loans are loans that are government insured by the Federal Housing Administration. FHA loans can be much more accommodating than other mortgages, but they do contain specific credit, income, and property criteria for a mortgage to get approved. One big benefit of an FHA loan is they only require a 3.5% down payment. So, as in our prior example, if you are buying a $100,000 home, you would only need $3,500 for your down payment. A VA loan is a federally guaranteed loan specifically for U.S. veterans and their families, and it requires no down payment. These are just a few of the loan types available, so be sure to ask your credit union lender what other types of loan options they may offer. Your lender can also help you weigh the good and bad points of each loan type, as well as the requirements and costs associated with each one, so don't feel like you have to make a decision right away. So, let's move on to your loan payment. Your monthly payment may consist of 4 parts: principal, interest, escrow, and private mortgage insurance, or PMI. Principal is the amount of your monthly payment that pays back the money you actually borrowed. Interest is, well, the interest you pay on the money you borrowed. Think of it as a thank you to the lender for letting you borrow their money. The interest you pay is based on the amount of principal you owe. So in this simplified example, if your monthly payment on a $100,000 loan is $536.82, the first payment may consist of $416.67 in interest and only $120.15 in principal. However, let's say by your 5th year of making payments, you've paid down some of the principal. That same monthly payment of $536.82 may now consist of $382.62 in interest and $154.20 in principal. In the first 7 to 8 years, your payment will consist of about 93% interest, which means you won't be building a whole lot of equity in your home initially. However, one day your payment will start paying off more principal than interest, and you'll see your equity building faster and faster. I look forward to that day. Escrow is the third part of your monthly payment. Escrow is simply money held in an account, typically by a third party, to cover property taxes and homeowners insurance. Some lenders will allow you to manage this process yourself, but most lenders prefer the protection of using a third party. And finally, private mortgage insurance, or PMI, may be the final piece of your monthly payment. PMI serves as an insurance policy for the lender, protecting them against default on the loan. If your loan enables you to put down less than a 20% down payment, you'll likely be required to pay PMI. You may have the option to pay PMI fees rather than adding them to your monthly payment, so talk with your lender to see which option is best for you. If you are required to pay PMI on your new home, be sure to keep an eye on the value of your home and the principal balance on your mortgage. As soon as you have the required amount of equity in your home, notify the lender it's time to remove your PMI premium. Once you determine how much you can afford to pay on a monthly basis, including principal, interest, escrow, and possibly PMI, it's time to find a realtor and start looking for your new home. Here are a few recommendations I have for you. Number 1. Locate a reputable realtor to assist you with your home purchase. Ask friends and family members for referrals or research realtors in your community. Number 2. Know how much home you can afford and don't be convinced otherwise. Oftentimes you'll qualify for a much larger loan than you can actually afford, but just because you can doesn't mean you should. In fact, as a guide, your monthly payment should equal no more than 30% of your net monthly income. Number 3, don't look at homes above your price range. You'll never like any home within your price range once you tour more expensive homes. And finally, once you decide on a home, let your realtor guide you through the buying process. However, it's never a bad idea to discuss negotiations with trusted friends and family members. Wow, we've covered a lot of ground, and you may be feeling a bit overwhelmed right now. However, I would like to leave you with one last piece of information. As you move into your new home, you are bound to have a few startup costs, such as a lawnmower, a rake, or maybe even a shelf above your washer. The good thing is, your monthly mortgage payments won't be due right away. Unlike rent, you make your house payment in arrears, which means your payment is due after each month you've lived in your home. So you'll enjoy the first month in your new home payment-free, which will help you pay for a few of those startup expenses. I'm heading out to pick up some things, so be sure to review this video a few more times to get more comfortable with the information, and print a copy of the Buying Your First Home worksheet available from your credit union. Although the home buying process may seem a bit overwhelming, I guarantee you it's worth it. And your credit union will be there to help you every step of the way. That's why I made the choice to have a voice. I am a credit union member.